Let's walk through the Enterprise Risk Command Center. This dashboard brings together the bank's key risk indicators into a single executive view. Instead of reviewing exposure, credit, fraud, liquidity, operational, and market risk through separate reports, users can monitor the bank's overall risk posture from one place. The objective is to support faster risk reviews, clearer trend analysis, and more focused discussions for the CRO Office, top management, and zonal leadership. We begin with the exposure overview. This page gives a bank-level snapshot of advances, deposits, investments, funded and non-funded exposure, and asset quality. It helps leadership understand how the balance sheet is growing, how the exposure mix is changing, and whether risk is building up in any part of the portfolio. At the top, we can see key indicators such as total funded and non-funded exposure, global advances, total deposits, gross investments, CD ratio, and GNPA percentage. These cards give a quick executive summary of the bank's current position, along with period-on-period movement. This helps users immediately identify whether advances, deposits, investments, or asset quality indicators are moving in the right direction. The advances versus deposits versus investments chart shows how the bank's major balance sheet components are moving across quarters. This helps users compare credit growth against deposit growth and investment growth. If advances are growing faster than deposits, or if investments are rising sharply, leadership can quickly investigate whether the balance sheet mix is changing in a healthy or risky direction. The funded versus non-funded view shows how much of the bank's exposure is direct funded exposure, such as loans and advances, compared with non-funded exposure, such as guarantees or letters of credit. The domestic versus overseas view helps users understand where exposure is concentrated geographically. Together, these views help leadership understand the structure of exposure, not just the total number. The total exposure trend shows whether the bank's exposure is rising, stable, or slowing down over time. This is useful because exposure growth by itself is not a concern, but exposure growth combined with concentration, weak asset quality, or rising stress can become a risk signal. Next, we move to credit risk. This view focuses on asset quality, slippage, rating migration, and capital efficiency indicators. It helps the bank monitor whether credit quality is improving, stable, or showing early signs of deterioration. The top cards show key credit indicators such as total gross advances, GNPA percentage, NNPA percentage, SMA1 plus SMA2 as a percentage of standard advances, RWA to gross advances, and BB and below share. These indicators help leadership understand both current asset quality and early stress. GNPA and NNPA show recognized stress, while SMA and lower-rated exposure help identify risk before it becomes deeper portfolio deterioration. The asset quality mix chart shows how the portfolio is distributed across standard, substandard, doubtful, and loss categories. The GNPA trend shows whether gross non-performing assets are rising or reducing over time. This helps users understand whether portfolio stress is improving or whether slippage risk needs closer attention. The SMA1 versus SMA2 views show early stress in the standard portfolio. SMA accounts are important because they indicate potential slippage before accounts become NPAs. By monitoring both the amount and percentage of SMA exposure, risk teams can identify where intervention is needed before stress moves into more serious delinquency. The rating mix charts show how eligible exposure is distributed across rating buckets, such as AAA, AA, A, BBB, BB, and below, government guaranteed, and unrated categories. The rating migration view shows upgrades and downgrades over time. If downgrades begin increasing, or if BB and below exposure starts building up, the platform helps surface early credit deterioration at a portfolio level. The internal versus external rating alignment view helps identify where the bank's internal risk view differs from external ratings. This is useful for governance because major rating divergence may require review, especially if a borrower looks stronger internally but weaker externally, or vice versa. Next, we move to fraud risk. This dashboard helps the bank monitor fraud incidents, fraud losses, actor type, geography, business segment, and governance indicators such as open cases and SCN pending. The goal is not only to count fraud cases, but to identify where fraud is concentrated and whether new patterns are emerging. The top cards show total fraud incidents, total fraud loss, external fraud share, internal fraud share, open fraud cases, and SCN pending. This gives leadership a quick view of fraud materiality, open workload, and whether the fraud profile is driven more by external or internal actors. The fraud actor type chart shows the split between external and internal fraud. The month-on-month trend helps users identify whether fraud incidents are stable, rising, or showing sudden spikes. If external fraud increases sharply in a particular month, the bank can investigate whether the increase is linked to a specific product, region, channel, or branch cluster. The fraud loss by actor type chart shows the financial impact of fraud across months. This is important because the number of incidents alone does not always show severity. A small number of cases may still create large financial losses, so the dashboard helps leadership track both frequency and materiality. The state-level heat maps show where fraud incidents and fraud losses are concentrated. This helps identify persistent or emerging fraud hotspots. For example, if one state has both high incident count and high loss amount, it may need deeper review, stronger controls, or focused investigation. The segment and region table breaks down fraud incidents and losses across business verticals and regions. This helps users compare fraud exposure across agriculture, corporate, MSME, retail, and regional combinations. It also helps identify whether fraud is concentrated in a specific segment-region combination rather than spread evenly across the bank. The fraud loss percentage trend shows how fraud losses are moving as a percentage over time. This helps the risk team identify abnormal spikes and investigate whether the increase is driven by a one-off event, repeated vulnerability, or emerging pattern. Next, we move to liquidity risk. This dashboard tracks liquidity strength, funding stability, deposit mix, wholesale funding dependence, and early signals of liquidity pressure. It helps the bank understand whether it has adequate liquidity headroom and whether the funding structure is becoming more or less stable. The top cards show LCR, NSFR, HQLA coverage, CASA ratio, wholesale funding as a percentage of liabilities, and bulk deposit ratio. LCR and NSFR are especially important because they show whether the bank is maintaining liquidity strength against regulatory and internal thresholds. The LCR and NSFR trend chart shows how liquidity ratios are moving over time against the regulatory floor. This helps users identify whether the bank is maintaining a comfortable buffer or whether liquidity strength is gradually reducing. The funding mix chart shows the split between retail, wholesale, bulk, purchased, and other funding sources. This helps leadership understand the stability of the bank's funding base. A higher retail deposit share generally indicates a more stable funding structure, while rising wholesale or purchase funding may need closer monitoring. The deposits versus advances growth chart helps users compare whether deposit growth is keeping pace with credit growth. If advances grow faster than deposits for several periods, it may create funding pressure. This view helps leadership monitor the balance between asset growth and liability growth. The purchase funds to total assets trend shows reliance on market or purchased funding. A rising trend may indicate increasing dependence on less stable funding sources. This helps risk teams identify early signs of funding vulnerability. Next, we move to operational risk. This dashboard tracks operational losses, fraud contribution to operational loss, high-value incidents, threshold breaches, near-breach flags, and loss concentration across event types, segments, and regions. The top cards show operational loss as a percentage of operating profit, total operational loss, fraud loss share of operational loss, high-value incidents, threshold breaches, and near-breach flags. This gives leadership a quick view of whether operational losses are within risk appetite, whether losses are increasing, and whether any indicators are nearing breach levels. The operational loss by event type chart shows which categories are contributing most to losses, such as fraud, process failures, system failures, external events, or people-related issues. This helps the bank identify whether operational risk is being driven by control weaknesses, process gaps, system issues, or fraud-related events. The monthly operational loss chart shows how losses are moving month by month. This helps users identify spikes, recurring loss patterns, and months that require deeper investigation. The segment and region charts show where operational losses are concentrated. This helps leadership identify which business segments or regions need stronger controls, better process discipline, or closer monitoring. The operational loss threshold chart compares actual operational loss percentage against a defined threshold. This helps users see whether the bank is operating within risk appetite, approaching a near breach, or crossing the defined limit. Next, we move to market risk. This dashboard tracks forex VAR, forex limit utilization, interest rate sensitivity, modified duration, PV01, SLR versus non-SLR mix, and currency-wise exposure. It helps treasury and risk teams understand the bank's exposure to market movements and portfolio sensitivity. The top cards show forex VAR as a percentage of capital, modified duration, PV01, and non-SLR exposure as a percentage of gross investments. These indicators help users understand whether market risk is within defined limits and whether the investment portfolio is becoming more sensitive to interest rate or forex movements. The forex VAR trend shows how market risk exposure is moving against the approved limit. The SLR versus non-SLR chart shows the composition of the investment portfolio. This helps users understand how much of the portfolio is in statutory liquidity assets versus other investment categories. The modified duration trend shows sensitivity to interest rate movements. The PV01 trend shows the estimated price impact of a 1 basis point movement in interest rates. If duration or PV01 increases, the portfolio may become more sensitive to rate changes, requiring closer monitoring. The currency-wise exposure chart shows concentration across currencies such as USD, EUR, GBP, JPY, AED, and others. The forex limit utilization chart shows whether utilization is approaching warning or breach thresholds. This helps treasury and risk teams act before approved limits are crossed. Next, we move to alerts and nudges. This section helps convert dashboards from passive monitoring into proactive risk action. Instead of waiting for users to manually check dashboards, the platform can notify the right stakeholders when a KPI crosses a defined threshold. Here, users can define breach conditions for any KPI. For example, alerts can be configured for GNPA crossing a defined threshold, LCR falling below an internal buffer, fraud losses spiking in a region, operational loss nearing a limit, or forex utilization approaching a warning level. Each alert can be mapped to severity, recipients, and delivery channels such as email, Slack, or Teams. This ensures that the right person is notified at the right time, whether it is a branch manager, zonal head, CRO office user, risk team, or leadership stakeholder. Now we move to the business views section. This section can be used to extend the current executive risk dashboards into more detailed business-facing analysis across advances, investments, deposits, and concentration. The Advances view helps track lending growth across products, segments, and geographies. It allows teams to see where credit growth is coming from and whether any portfolio pockets need closer review. The Investment view helps monitor the bank's investment portfolio at a high level. It can show investment mix, movement over time, and exposure across key investment categories. The Deposits view helps track deposit growth, deposit mix, and funding stability. It supports visibility into CASA, term deposits, bulk deposits, and how deposit growth is supporting advances growth. The Concentration view helps identify where exposure is concentrated. It can highlight concentration across sectors, borrower groups, regions, products, or large accounts, so teams can spot build-up risk early. Over time, the platform can also support additional views such as deposit ratio analysis, spurt analysis, capital management, regulatory ratio tracking, and capital planning. To summarize, the Enterprise Risk Command Center gives the bank a consolidated view of risk across exposure, credit, fraud, liquidity, operational, and market risk. It helps leadership move from fragmented reports to a consistent enterprise-wide risk narrative. Users can track trends, compare risk across segments and geographies, monitor thresholds, identify hotspots, and take action through alerts and nudges. With future business views, the platform can further extend into deeper drill downs, cross-risk overlays, concentration analysis, regulatory ratios, capital planning, and enterprise-level risk intelligence. Thanks for watching.